Hi guys, and welcome back to the Value Investor Show. Today I'm revealing two stocks that I have been adding to in September and will continue to add if prices make sense. These are stocks that I already own, but I have been building my positions, making them bigger in my portfolio. And in this video I will tell you exactly why and which stocks these are. So we'll go through each stock individually, my investment thesis, why they have been beaten down recently, and why this created a buying opportunity for me as a value investor. I'll walk you through the financials, the intrinsic value, and my plan going forward. So please make sure you stay tuned because we have a lot to cover. And as always, thank you so much for the support. I've been gaining subscribers a lot recently and I'm now almost at 2.3 thousand, but only 28% of you are actually subscribed. If the remaining 70% of you do hit that button, it will help me reach my 3,000 subscribers goal by the end of September. I put so much time and effort into these videos completely free for you guys. So if you can support me by subscribing, it really does push me to keep creating better content. Let's dive into stock 1, ASML. ASML is the giant in the semiconductor industry. It's one of the most, if not the most, innovative company in the world. Their machines are like no other. And after a massive rally in 2023 and 2024, the stock never really fully recovered and started trading at levels that didn't make sense, creating an enormous opportunity for value investors like us. ASML is not just a great business, it is an essential business. Without ASML, there would be no AI industry. They're a monopoly in the EUV lithography, an absolute bottleneck in the global semiconductor supply chain. And I've been talking about ASML since I created pretty much this channel back in July, and I'm up already 37% on my position this year. And I only entered this stock for the first time in 2025, and yet I'm already seeing significant gain. And I still believe we haven't even seen the peak performance for this company. ASML is a company that has grown revenue at 18 to 19% CAGR growth over the last decade. Yes, it's very cyclical. Sometimes there are quarters where clients are cutting spending, creating temporary dips. But if you really zoom out, because we are currently looking at quarter by quarter basis, we are seeing a company that is growing revenue overall. Back in 2015, they were doing 2 billion in revenue, and today they're almost doing 10 billion in revenue quarter by quarter. Their gross and net margins have expanded significantly, showing pricing power. They can pass costs down onto consumers who need their technology. With 100% of the EUV market share, they basically control pricing. Their gross margins are consistently above 30%. Their net income grows faster than revenue at 21% CAGR growth, and free cash flow has also been growing 14% CAGR over the last decade, giving them huge flexibility for dividends, for buybacks, and reinvestment, which they have been doing quite heavily as well in the past few months when the stock has been beaten down quite aggressively. Free cash flow per share is also growing, and it's growing faster than free cash flow is, which just shows the power of buyback. So the company is not only growing free cash flow, but they're also buying back share stock. And price to free cash flow has been in one of the lowest points for ASML in the last decade this year. And free cash flow per share has been growing quite heavily as well. And even better to that, another bullish signal is insiders. Insiders have been buying. Their CEO, their CFO, and other directors recently bought each $500,000 worth of stock. Add that to ASML's own aggressive buyback policy and you get a very powerful bullish signal. This signal shows that it's not just me and other value investors that have been adding, especially when the stock was closer to $700, but also insiders. And my largest buys have been in April. And I have been adding more in September when the stock reached down to, close to 700, low to 700 per share. And I will revisit, I will be adding more if it does reach those levels again. And when we say ASML has a monopoly, we mean it. Goldman Sachs estimates that China is 20 years behind ASML's technology roadmap. It took ASML 20 years and $14 billion in R&D spending and capex to migrate from 65 nanometers to below 3 nanometers lithography. And this is where China is currently at 65 nanometer tech. And it's not just the technical edge, it's not just the fact that the ASML has spent years and also multiple billions of dollars in R&D spending, but also the fact that this is the most complex process in the world. It's not that easy to create a plasma that is 40 times hotter than the sun. It takes decades, it takes billions of dollars investment. And apart from the technical side is the supply chain side, which is barely spoken about. Almost all ASML suppliers only supply ASML. The laser that ASML uses is developed by Trump, which is exclusively selling to ASML. The mirrors being sold to ASML by Zeiss are exclusively sold to ASML. So even if a competitor somehow replicates the technology, even if the competitor somehow finds billions of dollars to invest in and also has the expertise and the time, they will still face significant supply chain challenges as they couldn't access the same tech that ASML uses to become the #1 player in this industry, which is why ASML has the widest moat I may have probably ever seen, because it's so hard for anyone to even try and enter this market. This company checks all Warren Buffett's boxes. It has a durable competitive advantage. It has 100% of the EUV market share. It has predictable and historical earnings. It has high returns of capital. It has a simple business model. It only either produces and sells the machines or maintains them. These are the two main product lines. It has a rational and trustworthy management, and so they hit all 5 principles. This is why ASML is one of my top holdings, and this is why I have been adding more here, and I will continue to add more when the prices make sense. Now let's move on to stock number 2, which is On Holding, the premium athletics shoe company that I have been talking about since April. At one point, I was up 40% on this stock when it traded above $60 a share, but those gains have almost vanished and I'm now 7% off. This created another buying opportunity for me, especially in September, as I have been adding again, especially as it dropped to low 40s. And as I said again, I will reveal my full portfolio at 10,000 subscribers. On is growing at 57 CAGR over the last 5 years, an insane growth rate for an athletic shoe company. They're laser focused on the premium consumer segment, and that has been made clear. They don't want to be the next Nike. They want to carve out a new category, which is called premium athletics. And it's working. On has insane pricing and brand power. They're able to raise prices and consumers still buy them. They have gross margins above 60%. They have net margins of around 10%, especially when FX headwinds aren't crashing them like they have, especially this year. And in 2025, they had their best gross margins and EBITDA ever. But net margins, as I said, got halved because of unfavorable FX rates. Without those headwinds, without those FX rates, the PE ratio would be closer to 40 to 50 rather than 80 plus, which is currently at. Free cash flow also turned positive in 2023 for the first time, proving that they can turn profit into cash. They're also spending heavily on R&D, developing lighter material, but there's not enough data to judge consistently. However, their ability to turn net income into cash is thus proving strong. And we'll see how this plans out, especially as we see hopefully less FX headwinds in the future. Before we dive into the rest of the video, I want to thank today's sponsor, Fiscal AI. If you're serious about investing, this platform is a game changer. It gives you beautiful, clear graphs with all the KPIs you care about in absolute numbers and percentage changes. It has powerful forecasting tools so that you can project performance and even calculate a company's intrinsic value. It has industry benchmarks so you know exactly how a business stacks up, and it has detailed equity research papers with everything you need. Above all that, it's all integrated with AI, so you can leverage AI in every part of your analysis. This is honestly a no-brainer platform. I use it every single day, and for a limited time you can get 15% off using my link in the description and pinned comment below. Don't miss it, sign up now. The company itself has an economic moat. Apart from the fact that they have a premium brand positioning, which, as I said, allows them to maintain high profit margins, they're also focused on innovation, including the development of their light spray technology. This technology is what differentiates On offerings, and as they try to redefine the future of sportswear. And the biggest catalyst for the company, in my opinion, is the expansion into China. They continue to roll out stores, including flagship and larger stores in China and Asia, which aim to increase revenue share from those stores. In fact, the Tokyo store has already surpassed the region's street store, which is one of the biggest in Europe in terms of net sales. The second quarter results for the company were extraordinary. On running grew a massive 38% in constant current basis, which is more than many tech companies like, for example, Duolingo. So net sales increased 32% year on year, including the currency headwinds, or 38% on a constant current basis. Their direct-to-consumer segment also grew up 54% on a current constant basis, which is great because it also shows strong demand and also higher margins and more healthy margins. The direct-to-consumer channel is much more healthy in terms of gross margin. It does prove stronger margins, which is why On has also achieved the higher gross margin to date, up significantly from last year. I think this shows two things. One is that On is not only executing to grow massively, but they're also executing operationally to grow their margins, and they're doing so through their D2C channel. For the rest of the year, On is expecting at least 31% year-on-year growth in constant currency basis. They also expect higher gross margins and higher EBITDA margins, and I do think that they will beat all three. I truly believe that On can become a 10 billion in revenue company at least by 2030. With the new Asia expansion, I do not see how revenue growth will decline considerably, especially if you consider that the Asia expansion is growing triple digits. Yes, triple digits. In Asia, On running is growing in terms of revenue at least 100% year on year, which is just extraordinary. And so even in my kind of bull case scenario where I assume a 31% revenue growth, we are seeing that by FY 2030, this company would reach at least 10 billion in revenue. And this is a company that is currently priced at 15 billion in market cap. So in my valuation model, and this is my base case, I do believe that at $45, the company is still undervalued. In my base case, rather than the bull case, I assume 29% revenue growth, 29% EPS growth, and 25% free cash flow growth. Given the fact that I also don't have enough data, we haven't seen consistent growth in free cash flow, and I have used a P/E ratio of 44 P rather than the current 80 P. And under those assumptions, the intrinsic value with the DCF method is $69, and with the EPS method is $44, which gives me a margin of safety of roughly 0 to 35%. This is lower than my target margin of safety, which is 50%. But with that being said, I do think that this company is undervalued even at those current prices. I'm up 25% year to date. I'm heavily beating the S&P 500, and I will do a full portfolio reveal at 10,000 subscribers. So if you're one of those 70% watching who aren't yet subscribed, please hit that button and help me reach that goal before year end. Thank you for watching, and I'll see you in the next one.